Welcome to the Capital Exchange. Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
You know, Travis, real rates on Treasury bonds are negative as of the end of September. The nominal yield on the 10-year Treasury was 1.52. The core inflation reading came in at 4.04.
Yeah.
So that makes the real yield on Treasury bonds a negative 2.52. Not really good, is it?
No, not great, Steve. And it just shows that inflation is eating away at the value of our money. You know, on the other side of the coin, U.S. equity markets are hovering near all-time highs, right? Yeah. If you look at a few favorite valuation numbers, we'll start with the Buffett indicator, which is total market cap of all U.S. corporations divided by GDP, which is total economic output. That is trading near all-time highs. Next, if you look at the forward PE ratio on the S&P 500, that's trading at around 20 times forward earnings at the moment. And the 25-year average on that is 16.7. So valuations are elevated.
You know, Travis, we dig into those elevated numbers in the S&P that you just mentioned. You will find there are 5 companies: Facebook, Apple, Amazon, Alphabet, aka Google, and Microsoft, that make up almost 25% of the weight of the S&P 500 index. Those 5 companies have been responsible for most of the returns that we've seen in U.S. stocks over the past, aren't they?
Yeah, that's right, Steve. And if you step back and think about that, moving forward, we would anticipate what we call in the business reversion to the mean. So what that means is market leadership should broaden from here, and we would expect the other 495 underloved companies in the S&P 500. There's 505 companies in the S&P 500, but the other 495 underloved companies should be responsible for more of market leadership from here.
Next, Travis, I think that you have to look beyond the U.S. for return, don't you? Mm-hmm. If all the equity exposure is tied to the S&P 500, you probably really do need to rethink your strategy. We've talked about this, and emerging market economic growth is expected to outpace the U.S. and other developed markets over the next decade, isn't it?
Yeah, quite significantly. I mean, get this, Steve. If you think about this, in 1995, emerging market GDP, or economic output, was less than 20% of the entire global economy. By 2025, emerging market GDP is expected to reach 43% of the global economy. And fueling that growth is the expansion of the middle class in emerging market countries. And I'll give you 2 quick examples. China's middle class is expected to grow from 41% of their population today to 72% of their population by 2030. That's a lot more consumers, right?
That's a big number.
Right. In India, it's even better. The expectation is that the middle class expands from 21% today to 79% by 2030.
So those are 2 big populations.
2 big populations. And so looking outside the U.S. for opportunity at this point with the raised valuations we talked about earlier, it just makes a ton of sense.
Now, Travis, it does. This has been great. I look forward to it next week.
I look forward to it as well.
Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.